Every investor wants to get the most out of their return, which is the money they make or gain by giving up extra cash. And because risk costs money, every investor wants to reduce it as much as possible. When you invest, you take on risk, and when you take on risk, you expect to be paid back through a return. The more risk you take, the more you'll get back. So if you want a higher return, you must take on more risk. To reduce risk, you must expect a lower return, but you can also spread your investments across several different asset classes to reduce risk. When you invest in various types of assets, you are less likely to be affected by economic, asset class, and market risks. When investments are grouped together, the risk is also grouped together. Having more than one type of investment and therefore more than one type of risk helps spread bets. To really diversify, you need to buy assets that are not vulnerable to one or more types of risk. For instance, try different things between cyclical and counter-cyclical investments, which lower economic risk, between different parts of the economy, which reduce industry risk, between different types of investments, which minimize asset class risk, and between different types of businesses, which lower company risk. To diversify well, you need to look at your investments as a portfolio, not separate investments. If you pick your assets well and make sure they are really different from each other, the whole can be worth more than the sum of its parts. How to diversify your portfolio. Traditional portfolio theory says that there are 3 levels or steps to diversification: allocating capital, allocating assets, and choosing securities. Capital allocation means putting your money into investments with different types of risk. The short-term, less than 90 days, U.S. Treasury bill is an asset with no risk. Since it has such a short maturity, interest rate changes won't affect it much, and the U.S. government can't go bankrupt and have to stop paying its debts quickly. The first decision about diversification is how to use the money. It shows how much of the portfolio is invested in risky assets or how exposed the portfolio is to overall risk. That, in turn, will decide how much money the portfolio makes. The second decision about diversification is how to divide up your assets. This means choosing which asset classes, and thus which risks and markets to invest in. Asset allocations are determined by how much of the portfolio's total value will be put into each asset class. As the importance of these assets changes, the percentages are changed every so often to keep the desired allocation. Proposed asset allocation shows an investor's portfolio with a proposed asset allocation, hence the name. Asset allocation is based on how much each asset class is expected to earn and how risky it is compared to other asset classes. It also looks at how each asset class will affect the overall return and risk of the portfolio. If the asset classes you choose are really different from each other, the portfolio's risk can be less than the risk of all these assets put together. One type of asset allocation strategy is life cycle investing, which means changing how you put your money to work as you age. When you retire, for example, and stop working, you no longer get money from your job. Instead, you earn money from your investments. As you get closer to retirement age, you usually move your investments into less risky asset classes to protect their value. The third step in diversification is to choose individual investments within each asset class. This is called security selection. Here is your chance to diversify your industry, sector, or company. For example, if you wanted to diversify your portfolio or asset allocation by purchasing shares in a company, you would have to determine which company to invest in. Your stock portfolio will be more diverse if you choose companies in different industries or of different sizes or ages. You will have less risk than if you only bought stock in one company. Diversification is not about how many investments you have, but how different they are and how well they do. Investment strategies to diversify your portfolio. Capital allocation determines how much risk is in the portfolio, while asset allocation tries to get the best return for the amount of risk. Within each asset class, the choice of securities becomes even more diverse. Investing in index funds is a way to choose which securities to buy, just like life cycle investing is a way to divide up your assets. Indexes are a way to measure the performance of an entire asset class by looking at the returns of a portfolio that includes all the investments in that asset class. The index becomes a benchmark for that asset class, a standard that can be used to judge any particular investment in that asset class. An index fund is a type of investment that holds the same securities as the index. This lets you invest in a whole class of assets without picking individual securities. For example, if you buy the S&P 500 index fund, you purchase shares in the 500 most prominent companies in the United States. This is the asset class of large companies. Most types of assets have both indexes and indexed funds. If you don't want to buy individual securities, buying an index gives you the most diversification in that asset class. This way of avoiding making a choice about safety is called passive management. It also saves money on transaction costs, such as broker's fees, because you can invest in the whole index in one transaction instead of the many transactions you would need to make if you choose individual investments. On the other hand, active management means picking which securities to buy to get the best returns with the lowest risks. Investors who like active management think the benefits of selecting specific investments after doing a lot of research and thinking about them are worth the higher transaction costs. Actively managed portfolios can be diversified based on the quality of the securities chosen rather than their number. Also, asset allocation can be actively managed through a market timing strategy, which involves changing the asset allocation to prepare for changes in the economy or the market. For example, if there is more inflation in the future, you would put less money into fixed-rate bonds or debt instruments because inflation makes the fixed payments worth less. Change your portfolio so that more is in stocks and less is in bonds until the inflation goes away. Active investors or managers of investments, on the other hand, rarely do better over time. A manager of investments is not likely to get consistent returns in an asset class that is better than the returns of an index managed by doing nothing. There has been a lot of research on this topic, some of which are very academic. The reason why diversification is effective is that the dangers associated with every given investment will vary. For investors in a Canadian automaker that sources some of its specialty components from the Eurozone, an increase in the value of the euro relative to the Canadian dollar would have a negative impact on the company's bottom line. If that happens, share prices might fall as well. Any other investment you make will not face the same level of uncertainty. Lower your total vulnerability by spreading your investments over various assets. Diversifying a bond portfolio can be done by holding different bonds with different maturities and credit ratings. This is efficient because bonds with higher credit ratings react differently to economic developments than bonds with lower credit ratings. In the same way, the price of a bond changes in different ways when interest rates vary, depending on how long it has until it matures. One way to determine a portfolio's risk is to look at how often it changes. One investment's volatility is irrelevant to the overall risk assessment. Consider how this investment will affect the overall volatility of your portfolio. Volatility will be reduced if the investment's returns differ slightly from the portfolio's. Under normal market circumstances, a diversified portfolio may provide some safety. Diversification is effective because asset prices do not always follow each other in lockstep. In difficult market situations, however, diversification's benefits diminish. Conditions tend to become severe when the unexpected happens. A market meltdown or a default by the government are two such examples. When this occurs, market liquidity declines and asset values often fall. This was all for today's video. We hope it is clear why diversification is important to reduce investment risk, even though Warren Buffett doesn't like diversification. Please subscribe to this channel and press the bell icon to get the latest updates from this channel.